QQQ puts almost always cost more than QQQ calls the same distance out of the money. Not sometimes. Almost every trading day in calm tape and scary tape alike. And most retail traders read that single fact completely backwards. They see expensive puts and think the market is predicting a drop. Today I want to show you what that price difference is actually measuring and what it is not. Quick note before we start, this is educational commentary, not personalized financial advice. I am walking through a process, not telling you what to buy. Here is the wrong mental model, and it is everywhere. A trader pulls up the options chain, sees the 10% out of the money put trading at a much higher implied volatility than the 10% out of the money call, and concludes the smart money is bearish. So he shorts or he buys puts, expecting to get paid for agreeing with the crowd. Then QQQ grinds higher for 3 months while his puts bleed. The skew never went away. It was steep the whole time the market rallied. If skew were a forecast, that could not keep happening. So let's build the right model from one simple trade. Forget indices for a second. Imagine you own a house worth $500,000. You buy fire insurance. You also, hypothetically, could sell someone a contract that pays them if your house doubles in value. Which one has real demand? Everybody wants the fire insurance. Almost nobody is desperate to protect against their house getting too valuable. So the price of downside protection is bid up, and the price of upside protection is not. That price gap is skew. It is a demand imbalance for insurance, not a prediction that your house will burn. Now map that onto QQQ. Who holds the underlying? Pension funds, asset managers, retirement accounts, people already long tech. Their pain is a crash, so there is constant structural demand to buy puts as protection. On the other side, calls are what people sell to generate income against stock they already own. So you get persistent buying pressure under puts and persistent selling pressure over calls. That pushes put implied volatility up and call implied volatility down. The skew you see is the fingerprint of who owns the asset and what keeps them up at night. Let me put numbers on it so it stops being abstract. Say QQQ is at 500. The 30 delta put might trade at, say, 22% implied volatility, while the 30 delta call the same distance out trades at 16%. Same underlying, same expiration, same distance from spot. 6 volatility points of difference. That gap does not mean the market assigns higher probability to a down move than an up move of equal size. In a log-normal world, the up and down moves are not even symmetric to begin with. The gap means downside contracts are simply more expensive to rent. Here is the aha sentence, the one to carry to the screen. Skew is the price of insurance, not a prediction of the accident. When flood insurance gets expensive on the coast, it does not mean a flood is coming this week. It means a lot of people want to be covered and few want to write the policy. Options are identical. Steep put skew tells you protection is in demand and dealers are charging up for the risk of writing it. It is a statement about supply and demand for a hedge expressed as a price. So what does skew actually tell you that is useful? First, it tells you how much a crash hedge costs right now relative to normal. If you track the skew steepness over months, you learn what cheap and expensive look like for that market. When everyone is calm and protection is cheap, hedging is a bargain. When everyone is already scared and skew is at the high end of its range, you are paying a crowded price for the same insurance. That is a real, tradable read about the cost of protection, not the direction of the index. Second, changes in skew are more informative than the level. The level is almost always negative for equity indices. That is the baseline. What matters is when it moves. If QQQ is flat on the day but put skew suddenly steepens hard, that tells you someone is paying up for downside in size even though price has not moved. That is real information about positioning and fear. A steepening into a quiet tape is a different message than skew that flattens as the market sells off, which often signals capitulation. Watch the delta, not the absolute number. Third, skew shapes your expected move asymmetry. The options market prices a bigger, faster potential drop than rally because crashes happen faster than melt-ups. That is why the expected move is not a clean plus or minus band. If you are structuring a trade, the skew tells you that selling downside puts pays you more premium precisely because that side carries more tail risk. You are being compensated for a real hazard, not handed free money. Mistake that premium for edge, and you are the one writing the flood policy right before the storm. Now what skew is not? It is not a directional signal you can trade blindly. Steep put skew has coexisted with every major bull market in the Nasdaq's history. It is not a timing tool for crashes, and it is not a measure of how likely a decline is in any absolute sense. It is a price. set by supply and demand for hedges, filtered through how much risk dealers want to carry. Reading Skew as sentiment is like reading high-fire insurance prices as a weather forecast. You will be wrong in exactly the expensive direction. So here is what a disciplined trader actually does with this. You do not trade Skew as an opinion. You treat it as a cost input. Before you buy protection, you check whether Skew is cheap or rich versus its own recent range, so you know if you are getting value or paying up with the crowd. Before you sell premium on the downside, you respect that the extra credit is payment for genuine tail risk, and you size the position so a fast gap down cannot end your account. You let the Skew inform the price you accept, not the direction you bet. And you separate the two questions that beginners fuse into one. Question 1. Which way do I think QQQ goes? That comes from your own thesis, your time frame, your read of the macro. Question 2. How expensive is protection or premium right now? That comes from Skew. When you keep those clean, Skew becomes a tool instead of a trap. You stop shorting the market just because puts are pricey, and you stop selling naked downside just because the premium looks fat. If this rewired how you look at an options chain, that is exactly the kind of breakdown this channel does every week. Signal, not hype. Subscribe if you want the math behind the noise. To recap the handle so it sticks, Skew is the price of insurance, not a prediction of the accident. Steep put Skew on QQQ tells you protection is in demand and dealers are charging for it. It does not tell you the market is about to fall. Know which question you are answering, and you will stop paying tuition to the options market.